welcome to our latest Market Monday. I hope everyone had a great Labor Day weekend and was able to catch the kickoff to college football. Let's hop right into it for this week. They say certainty is the best friend for a central banker, and the Fed got exactly just that on Friday with the PCE reading coming in line with expectations. Given there was no surprises on Friday, we think the Fed's current policy to cut rates 25 basis points is still intact come September 18th. We went back and digested historical rate cut cycles, and there's been 18 separate rate cuts since 1970. But even more noteworthy, what we noticed is there's really two separate sets of rate cuts spread between those 18 rate cut cycles. So for the purpose of this episode, we'll call the first set desperation cuts, and that's where the Fed's cutting rates because we're either in a recession or heading towards a recession. And these have happened 11 of the 18 times. And then for the purpose of this episode, we'll call the second set celebratory rate cuts. This has happened 7 of 18 times, and this is where the Fed is tweaking its economic policy, like the current environment that we're in right now. So if we look over at the desperation side, this has happened, like I said, 11 of 18 times, and the average drawdown for the S&P 500 has been 16% over the next 12 months. So historically, when desperation cuts have happened, that has led to a forward S&P 500 return being negative. Now looking at celebratory cuts or rate cuts where the Fed is just tweaking its current economic policy, this has happened, like I said, 7 of 18 times. The forward S&P 500 return for the next 12 months has been positive 11%, with the average drawdown being 4%. And to us, that's very immaterial, given that's in line with normal drawdowns in normal market environments. So rate cuts are not black and white. It's not indicative that the S&P 500 is going to go higher because we're going to get a rate cut. And it's also not indicative that we're going to go in a recession because the Fed is cutting rates. It's very important to look at a range of outcomes and think very probabilistically than deterministically when viewing rate cut cycles. The reason we feel that we're still in this celebratory phase right now, and we all know things can change very quickly in the marketplace, but as we alluded to the last couple weeks, economic data has been very positive, and small caps have been outperforming large caps, and you typically don't see small caps outperforming large caps leading into a recessionary period. Now looking at September, historically from a seasonality period, September is the worst period of the year for stocks. And then on top of it, we have a looming presidential election in November. So it appears we're going to be in a very similar environment to what we saw in 2016 before President Trump was elected. And so what happened in 2016 was the market topped out in August and then went into a 5% drawdown leading up to the election. And then after the election, stocks popped and then finished the year higher. So we think we're going to set up for some type of similar environment, just given the uncertainty on who's going to be the next president. And then we think there'll be some more normalcy after that. But as we stated before, we expect a lot of volatility in the short term, but all signs right now still point to us being in a bull market. That's it for this week. Thanks for tuning in, and we'll see you next Monday.